For some people, their IRA or their 401k is the biggest asset that they have. And frankly, it's one of the most overlooked assets when it comes to estate planning. If you're doing a form estate plan, likely they're not even talking to you about your 401k or your IRA. If you're doing online forms yourself, or just hiring a $500 service, they probably aren't talking to you about what could be your biggest asset. So what are the rules for IRAs and paying IRAs upon your death, or 401ks? Rules are different depending on what kind of an asset it is. 401k is under the Employee Retirement Income Security Act, which is different than an IRA, an individual retirement account. I don't want to muddy the waters and get super complicated with that though. So here's some basic rules. Number one, make sure you have a beneficiary designation on that retirement account saying who is going to get it when you're gone. Basic. Number two, don't have it paid to your estate. If you have a retirement account paid to your estate, that's a really bad idea. Why? Because it may open up those funds to pay to creditors against your estate. Also, it can accelerate the time frame that those funds have to be paid out under the 5-year required minimum distribution rule. Whereas if you paid it to a person, for example, your child, it's a 10-year payout. If you pay it to your spouse, general rule is they get to take it over their life expectancy. If you pay it to a particular qualified type of trust, it'll pay out again under those same rules, either 10 years if the beneficiary is a child of yours, an adult child, or over the life expectancy if it is your spouse. So there are definite tax advantages that you need to be aware of to pay your retirement account correctly through a beneficiary designation. Now, one more thing I want to explain is that I mentioned earlier that 401ks in particular have special rules. It's because they're under the IRA Act. And under that act, the plan itself will likely say where your account pays to if you haven't made some affirmative designation. So for example, it may pay to your spouse by definition. And that spouse may not be the person that you want to receive that account, especially if you're newly married and you wanted it to, you're 60 years old, you're newly married, and you really want that account to go to your kids. Well, you have to affirmatively take action, and your new spouse has to sign a consent to say, it's okay if that money pays to the kids and not to me. And if you don't do that, upon your passing, there's going to be an unpleasant surprise for your kids that they're not getting it, the new spouse. You can be married just a very short time, new spouse gets it all. And that's probably, or that might not be what you wanted. And the reason that this happened was that you didn't look in and explore it and nobody told you about it. So an estate planning lawyer definitely can help you with that. So just make sure that your funds are going to go where you want them to go.